Hello, everybody, and welcome to the world of stockholders' equity. How exciting! We're going to start off with a little review where we're talking about the advantages of a corporation. The primary advantage of a corporation is number one, you have that limited liability that we talked about in Chapter 1, which means that if the corporation gets sued and goes out of business, the most that the owner can lose is its investment in the corporation, not their own personal assets. So that's a huge advantage for an owner. In addition, the corporate form makes it very easy to buy and sell shares of the company, which means transferring ownership is extremely easy. All you need is a brokerage account. You can go on your phone and click a few buttons and buy and sell shares of stock. So we can buy shares in small or large amounts, and we can also transfer it easily through established markets, the different stock exchanges that are available. A corporation is legally distinct from its owners, which means the corporation can own assets, incur liabilities, sue and be sued, expand or contract in size, and enter into contracts independently of its owners. Corporations are created by application to the state government, not the federal government, so each corporation is incorporated in a particular state. A lot of large corporations choose the state based on some favorable tax terms. Each state has different tax rules as it applies to corporations, so a lot of times a corporation will choose a state that has most favorable terms for corporations that are in that state. It's important to understand that when you have a corporation, if the owners were to die, the corporation continues. So if I have a sole proprietorship, as an example, Berube Consulting, LLC, let's say, and then I die, well, then Berube Consulting dies with me. If instead I am an owner of, say, Disney, and I happen to die, Disney continues and Mickey doesn't even shed a tear. So ultimately, the corporation is a separate legal entity that can continue with or without its owners. So as the owners pass away or as the owners sell their shares to another owner, it doesn't impact the corporation. The corporation continues on. So a corporation can last indefinitely. So what do I get if I own stock in a business? I get a voice in management, but that's a very small voice. Basically, what I'm going to be able to do is vote for the board of directors. And the board of directors, if you remember back to earlier chapters, oversees management to make sure that management is acting in the best interests of the stockholders. You don't get to make day-to-day business decisions because you're an owner. If I own stock in Home Depot, I can't run into Home Depot and start barking orders like, oh, I don't like these bird feeders, you should have these, and I don't want this or I don't want that, and I'm an owner, get out of my way. You'll just get kicked out. And in fact, I've told that story in class before, the Home Depot example, and somebody raised their hand and said they worked at Home Depot, and that's exactly what happened. Somebody came in and said, I'm an owner here, blah, 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 and tried to make changes, and the person was just ignored because that isn't your right as an owner. There's no way you can have millions of people that own large corporations making decisions. You can imagine working in a group of 3 people at UNH is hard enough, let alone trying to make decisions with millions of people. It would be impossible. So our voice in management is kind of like our voice in government. We get a vote, and then we hope that the person we voted for wins, and if they do, we hope that they do what we think they're going to do, which doesn't always happen. Then, in addition to our vote for the board of directors, we have the right to dividends, which is a proportional share of the distribution of profits. Remember, though, dividends aren't required. So a proportionate share of 0 is 0. So dividends are not required to be paid, but if they are paid, as a shareholder, we're entitled to our proportional share. So if we own 25% of the outstanding shares of stock, and a dividend is issued, we will receive 25% of that total dividend amount. That's what proportional means. And then a residual claim is a benefit of ownership we never want to have, and that's a proportional share of the distribution of the remaining assets upon liquidation. What that means is if the company goes bankrupt, we get our proportional share of any leftovers. Well, the leftovers are a lot smaller usually than the value of your stock initially, so this is not a benefit you ever want to see happen, because all of the debt holders have to be paid back first before the shareholders get their money back. So it's usually pennies on the dollar that you receive when a company goes bankrupt. So though it is a benefit of stock ownership, it's not one you really want to come to fruition. So let's talk about how the number of shares works for a corporation. The corporation, when they incorporate in the state that they choose, they have a corporate charter which basically lists the number of shares they're authorized to sell. And then they have a choice with those shares that are authorized. They can either sell them or not. If they sell them, they become issued shares. If they don't, they're going to be unissued shares. It's important to note that once a share is issued, it can never be unissued again. Once it's seen the light of day, it's never going to be unissued again. That's not to say that the corporation can't buy back some of those shares, but once they've been issued, they'll always be issued. So the issued shares can be converted either to outstanding shares or treasury shares. Outstanding shares are the shares still owned by stockholders. Treasury shares are the result of the corporation buying back its own stock. Authorized shares is the total. So if we had a total authorized shares of, say, 1,000, and then the unissued shares are, say, 400, that means that our issued shares would be 600. If treasury shares were 200, that means, or let's change the numbers so they're different. Treasury shares are 250. That means outstanding would be 350. Once a share is issued, it can never be unissued. Remember that. So if you don't like this little pie chart, let me give you some algebra. Authorized shares equals your issued plus unissued shares. And then your outstanding shares equals your issued minus your treasury. So for IBM, as an example, they have 4.687 billion shares authorized. They've issued 2.2 billion, but then they've repurchased 1.3 billion, so only 922 million are still outstanding because that 1.3 is held in treasury stock. Why does a company buy back its own stock? Well, they do it for a variety of reasons. One of the reasons is very similar to why a shareholder buys stock. Buy at a low price and hopefully resell at a high price. So that's one reason why a corporation buys back its own stock. You may have heard of employee stock compensation. So another reason why a corporation buys back its own stock is so they can offer those shares of stock to employees in the form of stock compensation. Another reason a corporation buys back its own stock is to increase the earnings per share. If there are fewer shares outstanding, you're spreading those earnings out over fewer shares, so then the earnings per share goes up and it makes the company look better. Speaking of earnings per share, let's take a look at how to calculate it. Earnings per share is our net income divided by the weighted average number of common shares outstanding. So that's why the treasury shares reduces the number of shares outstanding, and that's why it ends up increasing the earnings per share. Net income is reduced by preferred stock dividends, which we haven't really talked about yet, but we will by the end of this chapter. So companies are required to report earnings per share on their income statements. IBM's income was 5,753 million, and the average number of shares were 932.8. The average number of shares is usually calculated as the beginning outstanding shares plus the ending. outstanding shares divided by 2. So it's a simple average. So what this means is that for every share that's outstanding, IBM is earning $6.17 per share. As a general rule, the higher this is, the better it is for the company and for the owners. But you really need something to compare any ratio to. So here we can see IBM's earnings per share over time, and you can see it's been decreasing, which isn't a great trend. However, when comparing it to its competitors, Microsoft and Intel, even at its lowest point in 2017, IBM's earnings per share is still higher than its competition. So that is usually looked to as investors as a measure of profitability and health of a company, where the higher the earnings per share, the better the company is deemed to be in its performance.